Hello, I'm Alex Davies, founder of Wealth Club, and today I'm joined by Julian Dennard and Paul Mattick of Mercia Fund Managers. Hello.
Good morning.
Paul, perhaps first off you could just tell me a little bit about Mercia, who they are and what they do.
Okay. Mercia Fund Managers are an early stage technology investor. So we create diversified funds of EIS funds primarily across 15 different companies within various different sectors of technology. We have a lot of deal flow from universities, but also from our investment directors networks. And we create a fund, operate 2 closed-end funds per year, and we accept investments from professional clients at the moment, but also retail shortly. To invest into the fund, we aim to triple invested capital in 5 to 7 years.
Do you want to just tell me why you're well placed to do this?
I think Mercia has got a very experienced team of investment staff, led by a team of investment directors, some who have specific sector focus and can add value by the fact that they've been entrepreneurs in the past, but also we've got a team of experienced investment professionals like myself who've been in the industry for over 10 years. Have extensive networks, so we've got good business development contacts and can source early stage technology opportunities from a very broad and diverse area and base of towns.
And do you want to just tell me a little bit more about those type of companies you're looking for? What particular characteristics are they? Are they all university spin-outs?
No, far from it. I mean, we're trying to invest across a broad range. Some clearly will be in university spin-outs. That's a reasonably small proportion, but we're looking for technology companies that could be within innovation hubs or in incubators or in science parks, or even based in the centres of cities, such as here in London, or more importantly Birmingham, where Mercia is based. So it can be just pre-revenue or early revenue, or increasingly we're looking at slightly later stage opportunities for some of our funds to give us a better spread of investment opportunities.
And Mercia's, as you say, from Midlands. Do you have a regional bias in where you invest?
So we do. We're predominantly in the Midlands and the north of the UK. That's where our offices are. That's where our investment teams are based. So that's clearly where we have our best business development network and where we're sourcing most of our opportunities.
Just want to say, part of the reason we do that is for the value of the investment. So we find that the pricing in the Midlands and North is much more competitive, is less competitive, so we can define our price more effectively than in the Southeast and London, where we see the valuation of companies we're investing into tends to be quite a bit higher.
Very interesting. And do you want to, one of you just tell me the sort of, you talked about types of companies, but actually give some examples of recent investments you've made.
So one that I completed earlier this year was a business tool called W2 Global Data. That's a business that is in electronic identity verification and anti-money laundering. That's a very strongly growing market at the moment. There's a move to a verification online. For example, if you went into a bank to get a mortgage, it's very rare now that you've got a branch to go to take your passport and your utility bill. It's all done online, so there's a rapidly growing space, and the government is putting in lots more legislation around age verification, identity verification, all of which we'll be doing online. And W2 provides a sort of very broad platform, full service platform that enables companies, financial services companies and other types of institution to identify and verify their customers quickly and easily, so that they can open bank accounts or other things. So it's a rapidly growing space in the market.
Okay. So any particular investment types that you would avoid, or?
I don't think particularly, although Mercia's focus is on the 4 key sectors, which is electronics and material science, medical devices, digital healthcare, software and the internet, and then gaming, virtual reality and augmented reality. So we tend to focus on those areas where we do have a specialism, and we think they're all in growing markets and we can get the best returns.
EIS investors, you're interested in the exit.
That's definitely one for me. Yeah, so as I say, we do look to triple invested capital in 5 to 7 years. And so we do expect a 5-year holding period. This is very much a technology investment rather than anything asset-backed. So these are trading companies. It is high risk. There are companies which we expect to fail. So probably a third of the portfolio, any fund we expect to fail. And there's some downside protection from loss relief, etc. But the middle third might go either way, maybe return 1x, but the top third we will hope them to do really quite well. And we're seeing some of those kind of high performing companies within our funds. We have a number of companies being held in excess of 5x cost, which is encouraging. And the 2 early funds, over 3 years old, are averaging 2.5x, including tax reliefs. So that's fine.
And can you share with us particular names of companies that are doing well, or
so there's some which we can, and there's some which we can't. But the 3 which are in excess of 5 times original costs. So Dreams, which is a gaming company, doing very well within virtual reality. And there's a company called LM Technologies, which is Wi-Fi and that sort of space. And there's a new company called Oxford Genetics, in which Invesco just invested alongside Mercia into the company, and it's performing very well and growing very rapidly. We're looking for kind of 10x's within a fund, and we haven't got any of those yet, but Mercia is a broader group. We are quite a large group. We've delivered some really good exits in the last 12 months. There's a 26x and a non-EIS fund. There was another last week at a 55x. It's really exciting, and that's definitely what we're trying to do.
And I also believe, Paul, that you have a facility which actually allows EIS investors to get out early where necessary. Is that correct? And how does that work?
We do, but there's various caveats to this. This is our share exchange. When Mercia Technologies decides to invest in a company as a follow-on investor, then they may be given the option to sell their shares. The EIS shareholders may be given the option to sell shares to Mercia Technologies. So there's no guarantees around this at all, and it's very much limited liquidity, but it may be an option in some funds to get some of the liquidity out early before a full sale. And that is interesting, but we would see that as a supplement to the standard route of exit of IPO and trade sale. But effectively, it's not quite a buyback, but it's very limited scale. But it does offer some interesting options for EIS investors.
And a question for you, Julian. It's hard really to turn on the radio when people are talking about ridiculous exits, people pumping money into various high-tech stuff at extraordinary valuations. Are we in a bubble, and is it harder for you to find good deals at the moment?
I don't think so. I think inevitably when you turn on the radio, there are those stories, but they are relatively few and far between. The media tends to publicise these quite highly, but that's quite a small number of companies. Tend also to be focused in London and the southeast, whereas Mercia's focus is outside of London, and we're still seeing valuations that are at reasonable levels. We're seeing a good flow of deal opportunities, and certainly we're quite selective about what we invest in, and are mindful of pricing across the regions. But at the moment, I wouldn't say there's a bubble. There's still a really good supply of very good companies in the regions that are still looking for capital, and the regions where we are is particularly underserved, so hence the focus.
And bubble, I suppose, brings me on to risk, which you did mention earlier slightly, Paul. Are these things insanely risky, or if so, what do you do to minimise the risk for investors, other than we know about the tax relief? But
well, there's 2 parts to the risk mitigation. Part of it is the tax reliefs. So the downside, you only lose a third of your money effectively from income tax and loss relief. They protect the downside. But we create these diverse portfolios, and that also mitigates some of the high-risk nature of each individual company. And then you have the portfolio effect. That's one piece. The other piece is Julian's side, the investment team that are operation on the board. So we're on every company we invest in. We sit on the board, and we've seen a lot of these problems happen before, and we can help navigate around them for these very small trading companies. And that's something that actually Julian might want to say.
Yeah, I mean, I've been in this industry for a considerable amount of time, sat on lots of boards of lots of different companies. We've seen lots of the issues that these companies face, and so part of the role that someone like myself, an investment director who sits on the board of these companies, is able to bring our experience to bear to help the companies navigate through the funding issues that they may face, or the funding strategy, the recruitment strategy, the expansion strategy. So we've seen this all before, and we're able to provide help and guidance for helping them to grow.
So how hands-on are you then, really?
I mean, we're attending in every board meeting. So, for example, the company that I'm investing in, there will be a conversation once, possibly twice a week with the CEO in the early days, just to make sure that we're comfortable with how the business is running, the operations, strategy, and then it would tend to be perhaps once or twice a month on an ongoing basis. So there's a regular dialogue, and they feel that Mercia as an investor and a board member is actively participating in the way that this company is being run and grown. So, and I think they take a great deal of comfort from that fact. So we're active in our role.
And just turning to your university investments, university spin-outs, where are most of them coming from? Have you got any examples you want to talk
I think
about?
there's a broad spread. I mean, Mercia has a number of different university partnerships, and we've got a team that are active in searching for opportunities throughout our university network. It's difficult to say. Universities don't churn out a regular pipeline of opportunity. It's clearly dependent on the research that is commercially viable at any given point. So there's been a number out of universities across the West Midlands, in Warwick and Birmingham and others, and Leicester. But there's more widespread opportunities. We've got some out of Manchester and more up in Scotland, where we've got a number of partnerships. So they come out at an irregular rate, but they're fairly broad spread across the country.
That's great, thank you very much. And finally, before we go, if I'm going to invest in an EIS this year, why should I choose Mercia, Paul?
I think that's a pretty easy answer for me. Partly, the performance is very strong. As I was saying, we're averaging 2.5x within 3 or 4 years within our EIS funds, which is very interesting. But on top of that, our fees are pretty low, and so 1.5% annual management fee, which within the industry that's pretty cheap. And the two together create an interesting proposition, having a very experienced management team to sit on the boards and act on your behalf. And then we have the ability to provide limited liquidity via our share exchange, but also we really know how to do exits. Ultimately, that's what any investor should be looking at, is how do I get out of these investments rather than how do I get in. We have a great track record delivering some high multiple returns from Mercia, the broader group. So I think it's a very attractive proposition.
Paul and Julian, thank you very much.
Okay, thank you.